You are ridiculous.
Say something. Say what you want to say. Say what you want to say.
Nothing. Your Twitter account is great. I do follow you on Twitter now. So.
I actually think I have a... Oh, are we live?
Yes.
Well, welcome to With Sonar. There we go. Hey, by the way, how was the Tennessee-Florida game?
Not great.
We were talking about that last week.
It was not great.
Well, that's all right. I was rooting for you. I guess I was rooting for Tennessee too because I was rooting for you, but I don't really have a dog in the fight.
Yeah.
But it's your alma mater.
Yeah.
Sorry that Florida won.
Is
there a lot of trash talking between you and the fam?
No, not really.
We're over it. We're good?
Yeah.
Okay, well, that's good. Well, today, a couple of things we're going to hit on. We are going to get to the strike and really what that's impacting with the auto strike. Not a ton there, but some things to watch.
Yeah.
We're also going to take a look at, now that we're a couple weeks removed from Labor Day, what's the impact been to the truckload markets? And
you're wrong. That's what you're going to say. You're wrong. Just it's okay to admit it.
It's a little hot in here, isn't it?
The pressure's intensifying,
it's
isn't it?
Little toasty in here. What I was trying to say is that you were more correct. I was trying to be optimistic. Okay? I was trying to give the people something to root for.
Yeah. I mean, I don't blame you, but
yeah.
The different. Yeah, I know.
No, but it's true. It's coming down a little bit. It's coming down a little bit.
And if you looked at what the forecast was, it's forecasting it to come down after the holiday.
Yeah.
It's come down a little later, but you start looking at that forecast now.
A lot of it's due to reefer too, because we've seen the reefer markets take a big poop.
Well, yeah, they've gone from 10% back to 8% or whatever. But
I think it's even lower now.
Yeah.
6, I think is what I saw this morning, right? 6.5?
Something like that.
Either way.
And yes, I think one of the interesting things, especially when we talk about the NTI, is the skew towards dry van. And if you would have just looked at dry van rejection rates, independent of actual rejection, like instead of OTRI as a whole, looking at just the van side, they never peaked out. I think they might have touched 4% one day, and now they're back on the decline. So, I mean, you're still talking an environment where 96% contract compliance, most of any positive sign on the OTRI side was driven by the reefer market. It's come back down to earth, and some of that's seasonal, right? I mean, look at the areas that were popping up. You've got Pendleton, Oregon, Twin Falls, Idaho,
a little bit Minneapolis,
Milwaukee, like
Green Bay.
The more northern areas that are last to. I mean, if you were to think as the year goes, produce, and in this case, it's different things, right? I mean, it's not quite apple season yet, but it's approaching, right? But you've got potatoes, and those don't necessarily have to go reefer, but I mean, it's something that can help tighten the market. Barley, hops, and I mean, what is Milwaukee like known for, right? I mean, their baseball team's named the Brewers for a reason.
Yeah.
So, I mean, you just kind of think about some of these trends, and it's, okay, we're past this like seasonal blip. Then you factor in that Labor Day was around that too, and you're in a market that's more niche, and so it can tighten faster and more aggressively. I think that was what I was looking for, was how aggressive was the movement across all modes, and the dry van market just didn't budge with Labor Day. And I think that's kind of telling that we'll see where it goes, but like to your point, that it doesn't, where it's at right now does not make it look like contract rates are going to be below spot rates are going to be above contract price.
I mean, not, but I will say this, one maybe sign of hope for the dry van markets is that volumes have been steady and are still inching, healthy. Right? Yeah. They're inching, right? In fact, I was actually looking at them today on a 1-year chart. They're only down about 2% from where they were this time last year. Yeah. Now, obviously, we had already softened this time last year from our highs. We understand that, but The difference is now we're kind of we're heading up towards it as opposed to this time we were falling.
Yeah, no, I think that is a positive. I think the kicker is there's just too
much capacity.
Yeah, and
we're going to look at that too. Yeah. We're going to look at trucks leaving the market.
And I saw a post on LinkedIn, like talking about it. It's a carrier friend shutting down with. I mean, they had 4 trucks, and yes, we talk about it, the market needing to tighten, and I mean these are people's livelihoods that ultimately we're talking about having to basically close up shop and figure out something else to do. So it's hard to talk about it, but it's what happens in a cyclical industry, right? I mean, look at oil and gas, for instance. Like, they go through layoffs all the time, and they shut down those operations all the time based on the cyclical environment. Trucking is no different, and freight in general is no different. I think the difference is there's so many of those small fleets that it's not like you see layoffs of, I mean, you do, right? I mean, we talk about it. FreightWaves covers it, right? Laying off 10% of your workforce being 1,000 people or whatever. But when we're talking about churning capacity, it's not those jobs. It's the actual driver, the actual truck that we have to basically lose. It's not the back office employees. That's an easy cost-cutting measure for carriers to make, or brokers or anybody. But that's not what firms the market up. It's reducing the number of trucks on the road is what firms the market up. And I think that's where it's so difficult, because, again, you're having a conversation about effectively saying people are going to go out of business and exit the market in a way that you don't feel like it's just something that has to happen. It kind of loses the human element. And again, it's one of those things. It's got to happen, though. I mean, if anybody wants to make it, anybody wants to survive, it has to happen. Or not but to the market to go back up, that has to happen. And I think that's the part to remember.
Yeah, and I think we're going to see it.
Yeah.
It's just a matter of when and how quickly. Mm-hmm. The thing that folks are focused on immediately, right? So you see that volume trend. To me, that speaks that the market is actually healthy long term from a demand perspective. Mm-hmm. There is growth. There is natural organic growth in the market, right? But to your point, capacity has driven things down. And if let's go ahead and throw up our first chart, the NTI. So the NTI, great index. It's the National Truckload Index. We have this on a year-to-date chart right here, sitting at 228 a mile. That's all in. That includes the fuel. That's everything. That's the whole shebang. What we get up to, 232 a mile?
I think so.
I mean, so we got up to the 4th of July peak, and I mean, really the question is, are we just going to go hang out around that 224 range again like we were for so long?
It sure feels that way. I mean, it doesn't feel like the only benefit would be that you start looking into October and you've got things to help drive demand, but the market's ultimately rates are a product of supply and demand, not the other way around, right?
Rates are nothing more than an advertising mechanism to let folks know how much we need capacity.
Yes. Yeah, that's a great way to put it, because it's the outcome of it, and this is where you could teach an economics 101 class by understanding the fundamentals of the truckload market, because pricing is set by supply and demand coming into an agreement at a certain level. Now, the difference is they're rarely at that level of what the equilibrium place would be, right? I mean,
on the way up and on the way down.
It changes on a day-to-day basis too, right? Because just because it's balanced today, well, when a truck leaves and we have more demand, if we're not backfilling that truck in here, well, now we're undersupplied, right? So it plays out on a day-to-day basis that you never actually come to this equilibrium. But I think it's one of the perfect examples if you're trying to learn how supply and demand affect the price and the price alone, because again, it's a product of the supply and demand. Trucking and transportation as a whole is the perfect place to learn that.
So I don't know if everybody here heard it, but what Tony said is that I could teach economics 101. So basically, I'm an economist, Warren Buffett, and that's I appreciate it. Thank you. That's what I need to hear. But no, absolutely correct, right? I mean, it's the perfect supply and demand, right? And this is what we talk about, right? Sometimes there's this conversation: is trucking a commodity? It's 100% a commodity, right? Now you might argue that, well, no, these are people, these are real people. No, nobody's disagreeing with that fact.
That's the service aspect.
That's the service aspect, right? And people say it's relationship driven. Totally agree.
Yep.
But that relationship only works if you have an asset and there's a shipment that needs to go on that asset, a good that needs to go on that asset. That's the commodity, right?
Yeah.
Right? It's no different, right? It's the same thing, right, in oil, right? Oil is 100% a commodity. Nobody would argue with that. Yeah. There's service in that. There's relationships between who are you going to supply from, who are you going to buy from.
Yeah. Same in farming. With
no difference. Yeah.
I think the interesting one, and this is a conversation I've had recently, and maybe why index-linked contracts are so big and why it should be a focus, that it moves discussions away from pricing.
Yeah.
It moves it more to service. It moves the RFP away from what is the price. Well, if both parties know what the price is going to be, or it's reactive to the market, then you're basing your decision on not just not on pricing, because it's going to fluctuate as the market moves, but on service. And I think that's the important. That's where the relationship part comes in.
Agreed.
Right? It comes into the service component, which becomes even more important when you index link a contract, because you're effectively, you work out the agreement, right? Shipper and carrier work out the agreement that, hey, this is the index, and we're going to pay 10 cents above it at all times. Index goes up, so does your rate by the same amount, and you know what it's going to be roughly, but it protects you. But as long as your service, it makes that service component just that much more important, and it allows you to build that deeper relationship. So long as you have the OTIF that we require, so long as you're accepting all the tenders that we give to you, so long as you're on time and full, right? The shipper customer is going to be ecstatic because they know they're getting a fair market price. Stability. Exactly. They're getting a fair market price. They're getting the service required. They're not having to go out and buy capacity when the market turns. And I think this is the important part. When the market turns, and I say this from a broker perspective too, right? Why it's important from a brokerage perspective. Think of it as a buy side and sell side, right? They buy capacity, they sell capacity to shippers. They buy capacity in the open market. If they're index linking a contract, their sell side moves with the market. Well, their buy side's moving with the market too. But so from their perspective, they're protecting a margin. But the other impact, if they don't do it, right? What side moves faster? When the market goes up, what side moves faster?
Buy side.
Yeah, exactly. So what happens in that instance?
If you're the shipper, you're saving money.
If you're
hypothetically. Well, hold on. When the market
eventually your price
eventually your price is going to go up. The shipper tends to always be behind the market, because if prices go up, let's say you're working with a broker, right? Mm-hmm. Prices are going up, they're paying carriers more. Correct. So they're eating that initially, and they're like, well, shoot, we need to. We need to charge more.
Correct.
So oftentimes what will happen is they'll say, hey, we need to renegotiate contracts.
Yeah, and they have to go through this tedious RFP process.
They might even overshoot and go too high. We saw that happen a while, right? Contract rates took a long time for them to fall.
Yeah.
And then when rates fall.
Yeah, so it's a lot slower for them to come back down. So from a broker perspective, their margins get squeezed on the initial upside.
Yeah.
But if they're index linking a contract with their shipper customer, it's moving with the market. That margin can stay where it needs to stay.
Correct.
And say you're $1 billion brokerage, if your margin saved by 1%, it's $10 million. Seems pretty healthy.
I'll take $10 million.
You can make these changes, and it's conversations to have, but I think that's the important part to do. This is where that service component comes in, and having that relationship is to be able to one, show, hey, this makes sense from your perspective. You can put it into their eyes and show them why it makes sense.
Well, there's a lot of value behind it, right? From a broker's perspective, you're protecting yourself on the way up, right?
Yeah.
And even on the way down, when the market's coming down, right? You know, you're with the market. You don't have to worry about somebody coming in and underbidding you, right? And taking away your business. And from a shipper's perspective, it makes a lot of sense. You actually gain stability. And people say, well, no, the market goes up and down. There's no stability in that. Yeah, but you already don't have stability because you don't know when you're going to have to renegotiate and when you're going to have to do a mini bid and all this other nonsense.
Exactly. And how long do those processes take? And what is the cost of that process? And that's the important. If you could put a dollar figure on that cost and removing that time constraint, it'll show where the value completely is. And I think 100%. That's the key is, and why it's so important, and why, especially now, because, I mean, you think about it, right now we're in bid season.
Yeah.
And this RFP process, I mean, I was on a webinar last week, and I think the average bid RFP brings in 20 carriers, right? Sure. Whether that's asset-based or not, or brokers. How many people don't have access to freight? If you're only bringing in 20 carriers, and there's, 200,000 carriers and another 18,000 brokerages? Like, how many people are missing out on these potential bids? But now, it's still complicated, right? Getting involved. But if you can take that conversation and be like, hey, I can guarantee you we'll provide the service. We just need to index link our contract. You'll never pay you'll pay this at the market rate.
Yeah.
And we'll provide the service regardless of how the market moves. We won't fall off. How much more likely do you think a shipper customer is to say yes? Seems pretty likely.
They have a lot to gain from it.
Yeah. To me, and my thought is, what's the downside risk from a shipper?
The only downside, and this isn't even really a downside when you think about it, right, is...
They want to play the market when it's like this?
Well, no, I wouldn't even say they want to play the market when it's like this, but I would say, like, let's say I'm running I run the logistics for a Fortune 500 CPG company, right? CFO is like, how much are you going to spend this year on transportation, right? I can't necessarily give them a definitive answer, but also right now, you could also make the argument, the answer I give them right now anyway is based on
hopes. It's not going to be wrong.
It's based on no mini bids. It's based on hopes and dreams. It's also, not even that, it's also based on virtually no rejections, because if a shipper is smart, what they'll do in their budgeting is they'll say, okay, they may only base it off of the first carrier in their routing guide.
Yeah.
As you go through the routing guide, you get more and more expensive, and then eventually you go to the spot market. So it removes all of that variability. So in theory, it actually should be easier to budget.
Exactly.
But I think initially that will take that's a mindset change.
Yeah, it's being proactive in the market versus being reactive to the market. Yeah. And the issue is, again, it goes into the cost perspective of running the RFP. Yeah. It's a process that has been done the same way for however many years, right? I mean, for as long as any story I've heard, it's the same process. It's all spreadsheets and emails. And there's freight tech companies out there trying to simplify that. But the easiest way to reduce all of that cost, because how much more efficient could you be if you didn't have to sit there and just run RFP after RFP? You should be able to optimize and become even more efficient and use your human capital that you're paying money to drive efficiencies outside of just running RFPs. And that's where I think the index link contract dynamic makes sense, because again, the downside risk is whatever they base the contract off of. It could be, if the market turns tomorrow, I think on the way up in 2020, it took 54 days for the market to go from rejection rates of sub 2% to over 10%. 54 days. So effectively, less than 2 month period, contract rates, any contract that went into effect during that period was out of date by the second it was implemented. That was probably bid on 2 months before that.
Yeah.
So your budget is thrown out of whack the second those contracts are out of date.
And now it's all hands on deck to try to fix it.
And guess what? You're dealing with a volatile market in that instance. That good luck fixing it, because you're just going to have to fix it again a month later. And that's where you went into the MIDI bids. And again, they're time consuming.
Very time consuming, very distracting. And to your point, you can never run a bid and have it be.
It's never going to be accurate.
Well, even that, but it's like any bid that you run, as soon as you publish it, it's out of date. Like bids are guaranteed to be out of date. They're guaranteed to be out of date. Now, you can hope that the market's not volatile afterwards and it might be somewhat representative, but until when?
Yeah, eventually it changes. I think that's the key. We're in a cyclical market. It's going to go up and it's going to come down. And if you're not moving with the market in a rapid pace, you're going to be left behind.
All right, I want to change gears here for just a little bit. So we're going to talk about, so obviously index-linked contracts really help with the stability of the market, especially in markets that have been as volatile as we've seen over the last 5-6 years now. Demand is on the rise a little bit, inching. It's stability and healthy growth, but still too much capacity in the market. Let's go ahead and throw up our changes in net revocation. So this will show us, there it is right there. Look at that. So this right here shows, you actually put this in the Daily Watch, I think last week.
Yep.
This shows how many new trucking authorities have entered or exited the market every year. I've got this averaged out. So in 2020, we saw about 600. In 2021, we saw about 1,400 a week. And then in 2022, we saw about 400 a week. And right now we're losing about 400 a week.
Effectively, we're taking out the capacity we added in 2022.
Right.
We haven't even begun to sniff what we've added in 2020 or 2021. And I think that's the key, is that
now there has been some volume growth, so we don't need to sniff all of it away.
No.
But also the other thing too with this that I wonder is this index looks at the number of authorities. In theory, couldn't some authorities stick around, maybe remove some trucks?
Yes.
How often does that happen?
Oh, I don't know. I'd have to go look. I mean, follow what the big guys do and look at what their tractor counts do. I think that's one way to do it, because they'll be the ones to really feel it. But I think what's interesting is they're probably less likely to shed the trucks as fast as some of the smaller ones.
Especially, they've been in business like 20, 30, 40, 50, 100 years.
100 years, yeah.
It's like they know what's up.
Yeah, I mean, they've done it. And I think one of the interesting sides is you just see where the growth was in this, or not even in this. Go look at FMCSA's like tractor count growth, and it's all in the small fleet. That's where you add in an authority really easy. It's not one-to-one, right?
Yeah, nobody adds in a 500 truck authority.
Yeah, they're not just going to go, nobody opens up shop on a 500 truck fleet.
Yeah.
One, because right now, why would you? The cost of capital is so high with interest rates where they are. Like, getting the loan to do that is obscene. Yeah. But like, if you don't understand a lot of the entrants have been in the business, or they know somebody that was in the business and was making a killing and came in to try to do it, and they came in 2022 when the market had started its downward move. So I think the way I phrased it last week, there's just too much capacity still in the market.
Still way too much. And either demand has to go to the moon, or capacity is going to have to continue to exit.
Yeah, and there's just nothing on the horizon to suggest that demand's going to the moon, especially when you start looking at ocean bookings and things like that. They've just declined. I mean, they're declining, and I think that's the key. Is like, look what's happening upstream, because eventually that will even if inventory levels here are still high in certain places, right? Certain businesses have been able to shed inventory, but not everyone. If inventory levels are still high, we'll still move, like, volume could grow while ocean bookings fall, right? Because we're moving things that are already here domestically. Also, nearshoring, things like that. When you add in what happens Mexico, cross-border, things like that, not going to come on the ocean booking, right? But is it going to be enough to offset that at some point? And that's the question. There's just nothing to suggest like this check mark in volume that this would need to see to basically be healthy. And I think that's the key, is unless there was a check mark or a Nike swoosh going to the moon, the answer on the front to firm up the market is capacity has to leave.
It definitely has to leave, and we're going to continue to observe. Now, one last thing we're going to talk about before we part ways. We only have a little bit of time left, so let's go ahead and throw up the chart for Detroit, or excuse me, for the auto manufacturers. So this is wait times for the auto manufacturers. Hey, there it is. So this is measuring how long trucks are waiting at auto facilities, and I thought this is appropriate given the strikes. Now, the strikes, basically what this means is we've come up. We were at 95 minutes last week. Now we're at 109 minutes. Mm-hmm. A bit of an increase, but not out of the norm for the last year. Kind of right in the middle, actually, of the last year. So what this tells us is pay attention to it. Nothing to alarm yet, but just keep an eye on it.
Yep.
But that's about all the time we have for today. We will see you all next week, 2 p.m. with Sonar. Have a good day.